What's up, guys? It's your boy, Quick Stocks. As always, remember to hit those thumbs to recharge my dopamine, and we will get right into your quick stock analysis of Honeywell, ticker symbol HON, trading for $170 a share as of September 2nd, 2020, equating to a market cap of $119 billion and a fairly reasonable PE of 21. It is interesting to note, though, Honeywell is one of the few companies we have done an analysis on that has still not been able to recover to its pre-pandemic levels. So what's the move? Are we turning honey into gold with Honeywell, or telling them to buzz off? This is your quick stock analysis. Honeywell is a multinational conglomerate who primarily operates in 4 areas of business, including aerospace, building technologies, performance materials, and technology and safety and productivity solutions. Considering Honeywell's exposure to aerospace, the construction and real estate market, and oil and gas, it's not hard to see why the company still hasn't been able to break past its pre-pandemic levels. And investors should take into consideration Honeywell reported a 18% decrease in sales during its Q2 2020 earnings, which in all honesty certainly could have been worse. But pump the brakes! Honeywell is seriously a monster, and their segments expand into many aspects of our everyday way of life.
I'm making plans for takeoff before planes even land.
I'm helping make jet fuel from mustard seeds.
I'm making aerosols 99.9% safer for the planet.
I'm working on precision airflow control systems that ensure reliable room pressurization and directional airflow, controlling airborne pathogens and providing better infection control.
Now that we've got some hype in here, let's quickly break down these 4 core segments to see if we can make a better investment decision. Honeywell's aerospace components are involved in commercial, defense, and space-related aircraft, which has taken a large hit as the global quarantine brought air traffic back to the runway. When looking at Honeywell's Q2 2020 earnings, their aerospace segment had a revenue of $2.5 billion, down from $3.5 billion in the previous year, and the company expects third quarter to hold similar results. And this certainly is a shame, as Honeywell's aerospace division was once its crown jewel. However, as the world starts to regain a sense of normalcy, this certainly does provide the company with a chance to surprise analysts. Moving on, let's take a look at Honeywell's Home and Building Technology segment, which brought in $1.2 billion in Q2 2020, down from $1.45 billion in Q2 2019. This segment consists of fire and gas detectors, alerts, communications, and response products, along with advanced security systems, electrical, including products for lighting, power, and distribution systems, and comfort systems such as sensors that help control and manage energy, lighting, ventilation, and heating. Obviously, this market is extensive and offers investors great opportunity for decades to come. But an investor should take into consideration that there are a ton of products that Honeywell has had a soft monopoly on, such as thermostats. And I gotta admit, the times are changing. Products like Google's Nest thermostat are causing waves. Remember, the Google Nest is over 10 years old, and Honeywell hasn't been able to develop a smart thermostat that could even be considered closely comparable. An investor has to wonder if Honeywell can compete with these large tech companies as the world becomes more software-oriented. I will note on that in our final thoughts. Anyways, let's move on to Honeywell's Performance Materials and Technology segment, with a revenue of $2.2 billion, down from $2.74 billion in Q2 2019. This segment consists of fluorine technology, gas processing, specialty films, additives and chemicals, advanced fibers, intermediate products, electronic materials, process technology, and control systems for continuous process industries. As yet another example, Honeywell invented and patented R410A refrigerant, which if you have a residential air conditioner unit that is less than 5 years old, I'd be willing to bet that that system is using R410 refrigerant. Eventually, R410 will be replaced by R454B refrigerant, invented by a smaller company called Chemours, ticker CC. Once again, this is a singular example and it shouldn't be overextrapolated, but it does point to a changing in trends. However, remember, Honeywell is absolutely massive. Anyways, moving on, finally we have Honeywell's Safety and Productivity Solutions, which brought in $1.54 billion, down from $1.55 billion in Q2 2019. This segment made up of in-store retail solutions, barcode scanners, distribution center productivity solutions, and transportation logistics. As an example, when you receive a hospital wrist ID band, Honeywell has tech that scans the barcode to reduce errors. Anyways, I do want to quickly note, sure, Honeywell is losing its gatekeeper status in many of its products, but that doesn't mean the company isn't evolving in other segments. As an example, regarding Rona, Honeywell is working on business solutions. They're also working on developing packaging solutions for vaccines, including ultra-high moisture barrier vials without the limitation of glass. Honeywell's Thermal Rebellion, which one puts in the entrance of a warehouse or stadium that can identify if people entering have a temperature or not. They also have ultraviolet cleaning systems that help eliminate viruses. They are also getting in on the drone game, along with energy storage and renewable fuels. And all of this is really just scratching the surface. Honeywell really is one of the great American manufacturing companies. Anyways, moving on, a lot of hype has been driven to Honeywell in the last few weeks as it gained access to the big bad Dow index. This is great for Honeywell as it flows more cash into the company as these large institutions are forced to hold Honeywell when purchasing the index. Along with this, it also stirs up some hype for the company for retail investors, which the company certainly has lacked in the past. And regarding the company's balance sheet, here's a quick clip from their Q2 2020 earnings.
We ended the quarter with $15.1 billion of cash and short-term investments on the balance sheet and a net debt to EBITDA ratio below 1. The $15 billion of cash and short-term investments compares to only $3.5 billion of commercial paper and $800 million of long-term debt coming due within the next year. As you'll recall, we substantially completed our 2020 share repurchase commitment in the first quarter, and we were focused on liquidity preservation in the second quarter. We deployed $650 million to dividends and approximately $225 million to CapEx in the quarter. While being prudent on CapEx overall, we will continue to fund growth investments in the second half, and we expect full-year CapEx to be approximately $900 million.
As always, link in the description if you want to see more, but to sum up some clear highlights, they really are posed to endure whatever short-term tailwinds that may come their direction. As of Q2 2020, Honeywell reported a whopping $15 billion cash pile, up over 50% year over year. This fat chunk of change will be used for expansions and potentially more share buybacks. Finally, regarding the company's moat, they have an extremely strong brand name with an extensive ecosystem. And to no surprise, they have an absolutely insane list of patents. There's no way I can cover even a fraction of these patents in your quick stock analysis. As always, link in the description. So with all of this in mind, what's our move? To be blunt, if I wanted to start a position in a large multinational conglomerate, Honeywell certainly wouldn't be my first choice. And for transparency's sake, at my current age, I've got time to take riskier or more specialized investments that offer a better ROI on my money. However, once again, pump the brakes. I'm certainly not hating on the company. They are an absolute beast. Their balance sheet remains healthy with a whopping $15 billion in cash. One could certainly argue it's one of the few companies not overvalued in our current market. Along with this, the world is regaining a sense of normalcy, and its segments such as commercial air travel and production can get back on track. Management is planning $1.4 billion to $1.6 billion in cost savings, with 60 to 70% of the cuts expected to be permanent. And the 2.17% dividend yield is certainly icing on the cake. And let's be real, I wouldn't be surprised if we see a rotation into some of these companies who have been lagging behind. But as always, I'm playing that long-term game, and I think I can make better gains elsewhere. In other words, just because Honeywell doesn't match up with our quick stocks investing strategy doesn't mean it's a bad company. However, remember, I am certainly not a financial advisor. Do not purchase any shares just because you saw it purchased here on Quick Stocks. But that's all I've got for today, guys. As always, the best investment you can make is to go long on Quick Stocks. Hit that subscribe button now at 1,500 subscribers and plan an early retirement. I will catch you guys in the next one.